Hello, everybody, and welcome to this very special episode of Prinsights Global. I am so thrilled to have back, by popular demand, and because he is so awesome, John Rubino, who runs the Substack Survive and Thrive in the Coming Crisis at rubino.substack.com. If you're not engaged in that Substack, he has an amazing free and premium model portfolio and research component to his Substack. So get involved with that. We'll put up more details at the end of this. John, again, thank you for coming back. We last spoke in December. So much has happened since then. And we could really start anywhere, but maybe let's start with the latest GDP print for Q1 2025 at down 0.3%.
Hey, Naomi, good to talk to you again. Yeah, there has been an awful lot going on since the last time you and I talked. And we were, one thing that hasn't changed much is the GDP outlook, because we were kind of headed for a recession regardless of how the election went and what the new administration did and everything, because consumers had run out of money in the US. We basically built up a nice cushion during the pandemic with all the stimmy checks and rent forgiveness and things like that. And then in the ensuing few years, we spent all that money. And now American consumers are into negative territory where we're not only spending what we've saved, but we're going into deeper and deeper debt. Credit card debt is through the roof, and the interest, of course, on credit cards is also through the roof. Like if you're carrying ongoing debt that's charging you 25% a year, you're in pretty serious trouble. And the number of Americans who are in that situation is growing. So that means lower consumer spending going forward, more defaults on debt, and et cetera, the kind of stuff that leads you into a slowdown, which turns into a recession, which gives you an equities bear market. All of that stuff was always coming, and it's still coming. The GDP print, like you said, is now kind of sort of in recession territory, not deeply, but there. And there's no reason for that to change in the near term, because we're not doing anything that puts a lot more money in anybody's pockets. Without getting too political, Trump is accomplishing a lot of things, but at the cost of chaos in the short run, at least. And that chaos leads people to be more cautious about their spending. So that increases the odds of a recession in the near term. So, and again, that's the most normal thing about our world. Recessions happen and they kind of look like this when they happen. And so that's not that big of a deal. There's lots of extraordinary things that could either change the trajectory of what's happening right now or increase the velocity of the downturn. And we just have to hope that we don't have a bunch of those kind of black swan, gray swan kinds of things happen all at once.
Yeah, no, absolutely. And just before moving a little bit on, I want to touch on what you said about, the consumer and that just sort of lack of clarity compounded with record debt and record high payments on that debt, which is that we've just seen also, put another number into this mix, consumer confidence down to levels of just the few months into the beginning of COVID. And that also has an impact. We also saw McDonald's come in with a 3.6% decline in their sales for the first quarter.
Yeah, which isn't a huge surprise based on the fact that we ran through all our savings. And now we have a zero to negative savings rate for a lot of the country. So even places like McDonald's Walmart, McDonald's, places like that are where middle-class people drop down to when they're worried about their lives and losing their jobs and things like that. And then when the sales of even McDonald's and Walmart start to go down, that's when you know that the economy in general is contracting. And so we're not that far from that. And, I would say it's about time. We haven't had a really notable recession since 2009. So this has been a huge run in which debt at every level of American society has increased dramatically. So we're overdue for a period in which we get rid of some of that bad paper. But we built up so much debt that the process of debt reduction via default is likely to be more painful than it was even in the Great Recession. So what's coming could be a garden variety recession, or it could be something much worse, and we just have to see.
And you just wrote a really deep dive piece. Recession Watch Real Estate is already there. And you went into a lot of the components of what that looks like. And maybe you can talk a bit about that piece, how that compares to what we saw. You know, you mentioned 2009 in that run up, and just the parallels in what you're seeing now versus that.
Yeah, well, there are a lot of different parts of the real estate sector, and two of them are seemingly in big trouble right now. One is office buildings. Because over the last 10 years, a lot of office space went up using very cheap money. You know, we had extremely low interest rates, which made it attractive to build some big thing like an office building. And then came the recession, or I'm sorry, the pandemic, when a lot of people ended up working from home and found out that's how they like to do it. They don't want to come back into the office. So office occupancy rates are lower than they would be otherwise. At the same time that a lot of these office buildings have to be refinanced at today's higher interest rates. So you got a kind of a double whammy for office buildings where they're not generating much cash now anyhow. And all of a sudden their interest costs are going to go way up. So a lot of office buildings are changing hands at big losses right now. And a lot of that bad paper, a lot of those losses are on the balance sheets of local and regional banks. So you have the potential for a banking crisis that starts with a lot of losses in the office sector and then spreads to the banks, and that spooks depositors who pull their money out, and that causes a run on a bunch of banks, forces the government to step in and bail everybody out. And so that's another, $3 trillion or so that the government has to come up with at a time when its debt is at record levels and interest costs are going parabolic. So you get the potential just from office buildings going bust for a lot of dominoes to start falling. And then housing, single family housing, is a very different story, but maybe equally ominous, because it's not like there's this big bubble boom going on there now where people are doing crazy things and making money that they should never make. It's that house prices have gotten so high that nobody can afford them. So the average American cannot afford the average house, not even close. And that's kind of frozen the housing market. So home sales are down. Home building is holding up, but not for a good reason. That's because the home builders have bought a bunch of raw land and they put a bunch of houses in progress, various stages of building, and they can't stop now because they've got loans out on that raw land that they've got to turn into something that generates cash. And so a lot of new houses are piling up out there. At the same time, nobody can buy the existing houses. And so put all that together, and that is a negative for the economy. It means that other things being equal, housing is holding the economy back instead of driving it forward. So you take the potential for a bust in office buildings and just a frozen single family housing market. And those are kind of recession indicators too. So one could be a crisis indicator. The other could be a thing that just won't let the economy grow anymore until home prices fall by 40%, or till mortgage rates go down from 6-ish% right now to 3%. And either one of those would normally happen in a recession. So you kind of have to have the recession before housing goes back into balance, and not before. Housing cannot go back into balance until we have a recession that pulls a lot of money out of that market. So, however you look at it, the negatives outweigh the positives right now in today's economy, and we'll get the consequences of that in the not too distant future.
Yeah, it's interesting because back, financial crisis, of course, that was a subprime bubble. No one was really paying attention to it as it was growing. Refinancing rates at higher loan levels that couldn't be repaid. A lot of assets so piled on the top of that. credit derivatives market and so forth. And now we have the situation with, as you mentioned, office space, that, there's a regional bank issue, there's a single family home issue because of debt, and the fact that rates haven't gone down in the long end. So refinancing isn't really an issue. And the New York Fed recently came out with a report about, extending and pretending, which is sort of what the bigger banks are doing with respect to what is becoming a $640 billion, fast becoming a $750 billion set of unrealized loan losses that they're carrying on their books.
Yeah, these bank balance sheet issues are really interesting right now because there is a lot of bad paper building up. I mean, bad paper is building up everywhere, but the banks are where it can really bite because banks have to put out financial reports. They have to admit at some point what's on their balance sheet and what impact that is going to have going forward on their income statement. So they can hide that for a while, like you said, extend and pretend, but they can't hide it forever because a lot of assets change hands eventually, and then they have to generate a gain or a loss on that sale. And then once those numbers start becoming public and people start thinking about the implications for the banking sector, then you get the markets reacting to that. So you get kind of a bank run can happen from a lot of different directions going forward. And we can't know which direction it's going to come from, whether it's going to hit from office buildings or some other aspect of the banking industry or from derivatives again, Derivatives are always just looming out there. Yeah.
Right.
Yeah.
We know this. It's interesting too, because the Fed has not been really, beyond the reports that come out that are sort of regular reports about the system, debt, extending and pretending, etc., talking about this element of that potential drag on the economy, and that could be, as you said, a crisis or an acute combination of mini crises or something like that going forward. They've been really just focusing on the tariffs, on the inflation. Again, we just got this print of a lower GDP. So do you think that the Fed, to your point about rates coming down or, things getting significantly towards the 3% as opposed to 6% on the long end, do you think they're watching this more closely than they are noting, or they're not paying attention, which has happened before, or how that could impact monetary policy into this year?
I think the Fed is paying attention, but they don't know how to interpret what they're seeing because are tariffs inflationary or deflationary? And nobody really knows the answer to that because if they force prices up, obviously they're inflationary. But if they slow down the economy, then they're deflationary. And that's one of the things that caused the Great Depression was governments starting to put tariffs on each other's imports and exports. And Smoot-Hawley tariffs. That is blamed for the Great Depression being the Great Depression instead of just one of many downturns that we had back then. So it's possible that a trade war is deflationary and the Fed needs to be cutting interest rates really aggressively. But it's also possible that we're going to see higher and higher inflation prints going forward, in which case the Fed should really be raising interest rates in order to lean against that recession. And they don't know what to do. The Fed never really knows what to do until there's a gigantic crisis and there's no choice. But in between crises, they don't have the slightest idea what they should be doing or whether what they're doing right now is going to be a bad thing or a good thing. The stakes are a little higher right now because if you get it wrong in this kind of an environment with all the crazy stuff that's going on in geopolitics and trade and things like that, the consequences of a bad decision are more serious. And that just puts extra pressure on these guys who are operating with bad models to begin with. The Keynesian model doesn't really tell a central bank what to do. And so their experience in a lot of cases doesn't give them any background with which to make these judgments either. The Fed governors are not world-class economists in a lot of cases. So, the fact that our future is being determined by people who are operating with bad models and don't have any good experience and don't really understand today's world in the first place, and they're under pressure. So they're making decisions Trump is ordering them to cut interest rates right now, and that's the kind of pressure you don't really see publicly for the central banks very often. But they're facing that kind of pressure at the same time. They just flat out don't know what to do. And that's a recipe for bad decision making. So there's a very good chance that the Fed is going to do things that instead of helping make things exponentially worse, just because they have no idea what they should be doing, and that's our world right now. We've got a lot of big decisions being made that we really don't know whether they're the right decisions or not. And we totally don't trust the people making the decisions. And that is a recipe for capitalism not working, because who wants to build a factory in this kind of a situation where you don't know about inflation, you don't know about deflation, you don't know about war necessarily. I mean, we're threatening to bomb Iran right now. The Ukraine war is not over. It's better than it was, but it's not over. So this is the kind of situation where the risks and the uncertainties are high enough to dissuade a lot of investment. So, in other words, whatever angle you approach this thing from, it's suboptimal, and it might get better in the not too distant future. But right now, we can't know that. And that's a recipe for a recession.
Yeah, no, it is so scary, and I could not agree with you more that the people at the Fed really don't seem to have a clue, and aren't necessarily having the courage to even think about having a clue. And so that's been problematic, and that continues to be problematic. And all of the uncertainty elements that you mentioned are not going away tomorrow. But there is one area of the market, you've written about this a lot, and I know it's a cornerstone of your portfolio as well, which is available to your premium subscribers. But you had a piece out, More Tales from the Gold Bull Market. And we've certainly seen that the sort of investment and geopolitical and currency diversification sort of recipient of all of this uncertainty has been the gold market. And I wonder if you could give some of your thoughts on that.
Yeah, gold is kind of the flip side of what we were talking about, where if you're thinking about building a factory, you have to take a lot of things into account. And maybe you're going to say no to building that factory. Well, gold is the thing you buy instead of building the factory, because that's the safe haven. When things get crazy, you want to own something that's just been around for 3,000 years. It's held its value that whole time. And so under normal circumstances, you would see a lot of money flowing into gold right now, just given the uncertainties out there. But there are other reasons that gold is really rocking right now. And one is the BRICS thing. There are some countries out there who really don't trust the U.S. anymore to be even-handed in global monetary policy. We have been using the dollar as a weapon, and they want to circumvent that. And they've been accumulating a lot of gold to be able to back their currencies should that end up being necessary. And they haven't been very price sensitive. So that's one reason why gold has been going up. And another is that we're changing global banking regulations by redefining gold from a tier, I think it was a tier 3 asset, which is basically something you can have, but you have to keep reserves against that asset to protect yourself from fluctuations in that asset. Now gold is a tier 1 asset, which means it's like treasury bonds or dollar cash, which means it's money. So you don't have to reserve against it. That is the reserves that you use to protect yourself from fluctuations in your other assets. So banks around the world are buying gold as a diversification. They've got treasury bonds and they've got maybe some dollar cash. And now they want gold alongside those things. And they're not super price sensitive either. And I think, because one of the interesting things about gold is how it just blew from 2,000 to 3,400 in this beautiful fast arc, because normally you would expect 3,000 to be massive resistance, right? Because the human mind loves big round numbers, and that's where sell and buy orders accumulate usually. And with gold, 3,000 was not that. It should have been based on human psychology. But probably one of the reasons why it did just blow through $3,000 an ounce was the stuff going on with the banks. There were big banks out there who had been ordered to buy enough gold to do whatever. And so they had to keep on buying, even with gold at $3,000 an ounce. But it looks like maybe 3,400 was resistance, though. So we'll see. But I think, we've gotten ahead of ourselves with gold and could and should see a healthy correction here that takes it back down into the 2000s. But, there's no guarantee. It's possible that there's so much uncertainty in the world, and there's such a rush to get gold as a tier one asset or as protection against currency crisis if you're a BRICS country. And maybe they just keep buying. But what's been happening lately kind of implies that we might finally have a little correction after this gorgeous bull run in gold. And I think, we would still be in buy the dip territory in that case. If gold corrects, that's a chance to get what you missed out on getting when you didn't buy at 2,700 last time around or whatever. So I think a correction would be to be expected, and it would also be a positive thing probably if that's what happens.
Yeah, so we're looking at from a long-term investment perspective. You're either in gold and you're riding, or if you feel like you've missed it, what you're saying is basically like, if there is a dip, it's the opportune time to be a part of that.
Well, yeah, because we're all the stuff we've talked about so far doesn't really cover the global financial crisis that's out there because of all the debt we've taken on over the last 30 or 40 years. We still have a currency reset out there in the probable not too distant future that might involve gold as a reserve asset for all the banks. And we might go back to some kind of a gold standard. Who knows? It's going to probably involve gold one way or another when we have that new Bretton Woods that resets the global currency system. And that's still to come. I mean, that doesn't even necessarily have anything to do with what's happening right now, with the trade war and BRICS and stuff like that. So yeah, I think a correction in this gold bull market is just a chance to buy more, because the ultimate endpoint for gold, given how badly we're screwing up the world's big fiat currencies, I mean, people who run the numbers calculating what price gold you would need to be able to back the world's big reserve currencies, say 40% or so, like we did under the classical gold standard, they come up with a minimum of $10,000 an ounce. And some of their numbers just get bizarre after that, $40,000 an ounce gold, and because of that, it remains a buy at this level if you can psychologically handle corrections, which always happen in bull markets. And so, we could see gold go to 5,000, then back down to 2,500, and then back up to 7. Look at what Bitcoin does. And you'll see what is possible for gold as this stuff all plays out, because it's going to get very chaotic. The governments of the world won't give up their ability to create money out of thin air unless that's the least bad option that they're staring at. So you need a big crisis, or you need some very wise people in charge of monetary systems out there. And Trump has a few gold bugs. So it's completely possible that he gets in a room with some of these people and they talk him into going back to a gold standard right away. That would be by far the best possible outcome. And of course, it's unlikely, because giving up that kind of power means you have to have a really good reason to give up the ability to just create money out of thin air. Nobody would do that in their right minds unless they were staring at down the barrel of some kind of a gun. And that time will come, and then we'll do all this stuff. We'll have the new Bretton Woods. We'll set up a new monetary system. Gold will probably be involved at a much higher price. And then you get into the whole, will they confiscate gold and stuff like that? I mean, that's not a problem for today. That's a discussion later on. But right now, we've got a lot of reasons to think that monetary instability is in our near future, and that safe haven assets, gold for sure, but not just gold. I mean, silver is obviously the thing to buy now. Farmland, energy assets, uranium, as you and I have talked about in the past, is the uranium miners are probably great hedges against financial instability out there. So there's a lot of things you can move out of your financial assets, out of your government bond funds, and into real things that governments can't create more of. And that will protect you in general terms from these, unspecified monetary crises that we've got coming.
I was going to ask you what other areas you see that worth for investors, but you preempted because John, that is what you do. You have such an incredible way of looking at history, the present, and the future all in one moment, and you do present that in such a amazing way also in your Substack, Survive and Thrive in the Coming Crisis at rubino.substack.com, which again, I encourage everyone watching this. Seriously, if you're not on this Substack, watching and listening and reading what John has to say, you really have to. These times are simply too, as John said, chaotic not to. And John, you're always so clear. I so appreciate you. Any final words before we tune out here?
Thanks for those kind words, Naomi. I really appreciate it. And yeah, I think that it's important to look at all the stuff we talked about as an investment thesis rather than as, oh my God, the world is coming to an end, because it's really easy to get wrapped up in the darkness with all the things that are happening out there in the world right now and let that dominate your viewpoint. So but if we can kind of switch gears and think, all right, crazy stuff, it's coming, it's happening now, it's coming later. But look how much money we could possibly make if gold goes to $10,000 an ounce, or the uranium miners do this or that or whatever, or if we short the NASDAQ and we have another, big short kind of 2 or 3 years there. So there are a lot of things that we can be doing that'll improve the lives of our families and our friends, and just allow us to protect the people that we care about. And that's a way healthier way to approach this than to focus on the dark, scary things that are happening.
Well said. Again, John, thank you so much for joining. Hope we continue to have these conversations. I love reading everything that you write and think. And everyone else, thank you so much for joining us here again today at Prinsights Global.